This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Paul Foley of Smart Capital. Paul, thank you for joining us.
Glad to be here. Thank you for having me, Hall.
Great. So how did you get into early stage investing?
So after my last company, which was called Augur, we did ad tech attribution and personalization. When we sold that, I basically went around and started investing in friends' companies here in Denver. And I was also, most people don't know this, but Colorado there's really only 3 VCs here. So everyone knows Foundry, everyone knows the Techstars, the accelerator, but the Techstars also has a fund. And then there's another larger VC kind of in between Boulder and Denver. But I was looking to actually get into venture capital. And when I was looking around, it was kind of clear that there's tons of entrepreneurs here in Colorado and across the Midwest. But as far as capitalization, it's something like 40% of all venture capital is in Northern California, and then 20% is in New York. It seemed kind of an obvious choice that if there was venture capital more spread out across the rest of the country, there would be a lot more like opportunity. So I started playing around with friends on different ideas. And what we kind of came up with Smart Capital is this investment strategy where, one, we thought that anyone should be able to invest into more of a fund structure than just individual companies. So if you're an angel or unaccredited, having the same kind of opportunity. And then the other thing that we determined was there was a ton of companies in the Techstars network, which is kind of our first fund focus, that are revenue generating, have lead VCs, and we could follow on their rounds. So we created this fund structure. So the first fund that's getting launched on Smart Capital is a fund that goes and invests in revenue generating, Techstars backed and VC led companies. One that reduces risk for the investor because now they're getting in good deals already vetted by VCs. 2, in the Techstars network and program, you have like a 3-month accelerator type school where the entrepreneurs learn a ton about how to grow and build a startup. And then obviously, revenue generating de-risks a lot of things. So when you have revenue, it means that at the very least, you've identified a problem, you've been able to build a product, and you now have the ability to put those two together with getting some money and revenue. So that's kind of a long way of saying, but that's kind of how this whole thing started.
So for those startups out there that want to join your portal, what is the criteria they have to meet in order to get in, or who's a good fit for your program?
So the portal itself is a little going to be different than a normal crowdfunding portal. The theme is going to be individual funds launched at a time. So a company that's looking to be a part of this, what we're going to do is theme. So obviously the first theme is kind of this Techstars revenue generating VC-led companies. Another theme is probably going to be something around machine or deep learning. So companies that are doing innovative things with new technology, again, that have VC leads that we would follow on. The companies themselves, when we put up a new fund thesis, we have kind of a network of scouts or other entrepreneurs that kind of help source the deals. It's more we come to them as opposed to they come to us. So it's a little different than a normal portal where like a seed investor or other would have the companies come and pitch and apply, and then the individual company would get up. What we're trying to do with the fund strategy that we're doing is the first fund is going to have 30 companies. So the idea is that with one investment by the investor, you're diversified across 30 companies, which I think is important. So we're more acting as a VC or as an aggregator than a normal portal would.
And so when you have revenue generating, what's kind of the minimum revenue you're looking for to say, yeah, you're to be considered versus you're not?
Yeah, that's a really good question. And it actually varies by company. What we found is around the 10K per month is a good seed round. And a lot of VCs have funded companies that are generating 10K MRR, which is like over 100K ARR. And so there's the seed, like we're talking about like $1 million, $500K to $1 million in funding for those companies in their seed rounds. The larger companies, so there's some companies in the fund, and I can't disclose the companies just yet, but there's some larger companies which are actually doing millions of dollars in revenue already that it's kind of we're falling on their Series A or Series B. So it's more variant depending on the stage of the company. And we actually wanted to have multiple stage companies. So we wanted some earlier stage companies that we were getting better valuations at. and we wanted some later stage companies which were producing more revenue. When you're producing millions of dollars of revenue, the company's obviously a lot safer at that point.
And how is it the same or different than, say, a syndicate approach?
Yeah. So with a syndicate on AngelList, the investor's picking companies based on whoever the syndicate lead is. So we'll use Naval Ravikant as an example. If Naval had a syndicate, he would go around, find companies that he was interested in and say, hey, I'm investing in this company. Do you want to invest as well? The difference between this and a syndicate is that the company is already chosen. So it's going to be 30 companies already pre-chosen, already deals negotiated. And with an investment, you're kind of investing in the portfolio strategy as opposed to individual companies and picking and choosing. What we found with the syndicates is that investors got really excited about it at first. And it was kind of nice to go in and be shown deals and then pick the companies you want to do. The problem is the enthusiasm wanes over time. And the other thing, too, is a lot of times in a syndicate, you still don't do enough deals to be diversified. What we found is that most VC funds invest in around 30 companies as a way to diversify. Most syndicates, even if you join a syndicate, a lot of times you're only doing around 5, maybe 10 deals, which is better than one, right? But it's still not enough to be like completely diversified.
And what do you think the impact on the returns is from that?
So I keep saying that's a good question. These are good questions. The biggest thing around the returns is as you know, when you do an investment in early stage companies, it's more of a power law. So there's probably out of 30 companies, there's going to be 3, maybe 4 that kind of return the fund or make all the returns. And then there's going to be around 15 of those that are going to just potentially get your money back plus a little more. And then there's probably going to be like the straggler 10s that just completely go out of business. Maybe it's 15 that goes out of business. But the idea is there's going to be quite a few that go out of business. There's going to be quite a few that just give you your money back. And then there's going to be 3 or 4 that actually do well. So you need to have those 3 or 4 in there. Now, micro VC funds in general usually have around, it's a 2 to 3x, which is great. So if you're an angel investor or a unaccredited investor, the average person, those kind of returns are awesome, especially when the money's managed for you. You have somebody looking after the investments for you, which is huge.
So how long you've been in operations and what kind of track record can you put out there so far?
So unfortunately, the SEC doesn't allow us to say the numbers related to the fund offering because each fund is going to perform differently. So that's kind of an unfortunate way of, it doesn't allow us to give a lot of investor confidence. But if you look previously at, if you want, there's the Techstars specific, we can't even use the Techstars number specifically, but they're published. So if you want to go out there and look at what Techstars has returned to their investors, it would potentially be something similar to that. The other thing to note about this is you're not investing in a fund with a VC fund manager. So you're not going and investing in Paul, Marco, John, and the fund. You're investing in a portfolio, if that makes sense.
So what are the costs? In the VC fund, they had the 2 and the 20. What is the cost here for the investor?
Yep. So there's still a 20% carry, and then there's a 2% per year for 5 years. And so the reason behind that is it actually is going to get extended beyond 5 years of just management. But there's all kinds of costs associated with helping those companies run until they exit.
So a lot of VC firms are now providing services. They do the back office, they do the marketing, they do the CFO. Are you providing services like that as well, or no?
Yes, 100%. So the services that the offering, so the first fund offers, and it's up to the startups to take it or not. We don't want to force them to pay us after giving them money. But as you mentioned, most startups will pay for something like a cap table management, which basically just shows who owns what. So we're talking about Carta, CFO, or an outsourced CFO to do financial projections and revenue runway, or cash runway, as well as accounting. So always have fractional accounting to make sure your books are good. And then obviously tax and audit come with that as well. So there is services provided to the companies when the investment happens, as well as just overall, so one of the things about our team, specifically at Smart Capital, all 3 of us, so my 2 other co-founders, this is each of our third company. Me and John have pretty good exits. And then the company for our third co-founder is one of the faster growing companies in Colorado. So we have a pretty good track record operationally. And so there's a level of advice that goes along with it. I know most VCs say that, but when you're operating as a startup as well as have operated a startup, there's just a lot of understanding that goes into helping those companies grow.
So who is the ideal investor you find for this approach? Is it an angel or angel group or high net worth individual? But who do you think is best fit for it?
I think angels that are looking to invest in startups that have around, let's say, 100K. The thing about investing 100K usually into a normal deal is that you're probably going to, if you're doing individual deals, you're probably putting in 25K each time. So to get to maybe 10. So if you're doing 20K per deal, let's just use that number, and you try to do 30 deals, that's 600K. So that's a lot for most angels, and the risk tolerance is kind of high. Also, you have to then go and do kind of your own diligence, and then sometimes you also have to look over the legal contracts yourself. So with this one, we're looking at high net worth individuals that want to get the diversity in 30 companies without spending $1 million in investing, as well as don't want the headache of going and looking over, one, sourcing 30 deals, and then two, looking over all the term sheets for those 30 deals, and then also paying legal to look over those contracts as well. So it's kind of like highly active angels probably aren't the best fit, but angels that are, hey, I want a good diversification. I want to be in really good companies, and I don't want to have to spend a ton of time doing it. Like a full-time job would be finding and vetting and investing in these 30 companies.
So how many funds have you done so far? You've done Techstars, you're doing machine learning, but how many have you done so far?
So you asked earlier, and I probably didn't answer this super clearly, but the website and company formed back in January of this year. So we are relatively new. So it's now end of May. So we're 5 months in. First fund is looking to launch around September, so in the fall. So the first fund is actually not even out yet.
Okay, so you're just launching the first fund in this case, but you have several on tap, it seems like. Aside from machine learning, what do you think the other ones might focus on?
We got a huge demand for biotech. We found that actually there's a lot of investors that both want to save lives as well as make money. The other thing is energy has been huge. So kind of this renewable future, as well as, blockchain is all the rage right now. We're trying to figure out how to do blockchain or get into blockchain companies early on. A lot of them are doing token sales, which we want to stay away from right now. So that's a potential theme based on what we can do in the future. But I would say like a AI type fund, a energy type fund, and a biotech fund would be the next three that we would launch.
Well, that's great. So we've seen crowdfunding come up, and this is technically not crowdfunding, but it seems like it's taking some lessons from the crowdfunding world. Where do you see the market going in the next 2 or 3 years in this space?
To clarify, this is crowdfunding. This is allowing anyone, so the average investor, to invest into this type of structure. So this would be the first time ever that the average person would be able to get into a portfolio type of companies.
This is only for accredited investors, and when I talk about crowdfunding, sometimes people automatically think non-accredited investors. Sometimes they think Kickstarter. Sometimes so it has many different meanings. But just to be clear, this is for accredited investors only, right?
Nope, it is for anyone. The average person
can invest. Yeah. Okay, so if you're not accredited, how do you get to invest?
So we actually are doing a Reg A Plus offering. So this is a crowd fund. We are Form 1A right now with the SEC. We've been working with the Division of Small Business, which houses crowdfunding. So the idea is that with the portfolio model, with crowdfunding, you can invest in one company at a time. It makes more sense to invest in 30 companies at once. The other thing, too, is this is not an open-ended fund. So as I was saying earlier, it's not that we make investment decisions after the fact. It's here's the 30 companies, here's the terms for all 30 companies. And once the investment goes in, it goes into the 30 companies immediately. What the SEC tries to avoid is open-ended funds. So what they don't want is crowdfunding for an open-ended fund, which then operates over a span of time. What the SEC would want is early-stage startups getting deals, and this is a way to do that. So this is 30 companies all at once, as opposed to individual companies one by one.
Oh, that's great. That's great. I understand better now. Reg A Plus is a great new tool, and it's great to see it being used to get funds out there as well. In the last few minutes we have of our interview here, what else should we cover?
So to answer the question about where crowdfunding in general is going, I think you're going to see it try to be expanded a little bit more / revamped a little bit. I think it hasn't lived up to the initial promise. So if you're an unaccredited investor right now, going on to the current platforms, a lot of those deals are there's still good deals on there, but some of them are not the best deals because they're individual companies that have kind of been rejected by VCs. What we're doing is actually interesting because we're following on VCs the companies already have VC funding, and this is just follow-on investments. And if you're looking at crowdfunding, they understand that a lot of the best companies aren't using this method of raising. So the the ones that are responsible for crowdfunding in general are looking at ways to improve the legislation around it. Also, I think there's a fascinating merger right now of blockchain and crowdfunding. And I think that we're seeing a lot of utility tokens, which are obviously not securities. They're these tokens that can be used in the app at a later date. The idea, though, that a token can be a security and then can be represented as ownership in the company is kind of this new, it's been all the rage for basically the last year. And you're going to see a lot of companies coming out that are allowing companies to do these raises where they're offering a token, but the token actually represents ownership in the company. And there's a lot of reasons why you'd want to do that from a technical perspective, but it's going to be fascinating. I think we're going to see crowdfunding and just the average person being able to invest in startups become much higher in the next few years.
It will be interesting to see how it plays out. Tokens bring a great new dimension into this effort, and it'd be great to see how they play out with it as well. Well, I appreciate your taking time. How best for the audience to get back in touch with you?
Feel free to email me with questions. So my email is paul@smartcapitalx.com. I live in Denver, Colorado. We have a great startup scene here. So if you're ever in Denver, feel free to email me, but then also feel free to message me and we'll get coffee too.
Well, great. We'll put that in the show notes as well and let people get back in touch with you afterwards. Appreciate your taking time and hope to have you back in the future for a follow-up on this discussion.
Sounds good. Thank you for having me, Hall.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.